Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amerant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Marengo Family Foundation, and these friends. Welcome to the second part of the Banking Executive's Outlook for Lending in 2020. My guests today include Blair Ryder, M&T Bank, Daniel Harris, Ocean First Bank, Kevin Cummings, Investors Bank, Frank Korzakwinski, Flushing Bank. Dan, you're the new kid on the block. I mean, Ocean First came into New York about a year and a half ago. Where are you trying to put your money out, and what type of deals and loans?
We're a $10 billion bank. We have a $6 billion loan portfolio through New Jersey. I was brought in to start lending here, and then we brought Country Bank. We're seeing a tremendous number of opportunities now. Country Bank has about a $500 million book of various types of properties. The things we're looking at now and we've been successful in, and we've been successful with industrial, warehouse, certainly credit tenants we've been chasing fairly aggressively. We've been using our swap program to be able to lock in long-term rates for the borrowers on commercial properties. That market is very strong right now for us rate-wise. Some food anchor, small strips. The bank has some construction loans going, but our focus really has been in the industrial warehouse, some office, not too much, some suburban office. I mean, office is, of course, incredibly challenging right now. I don't think any of us can predict what this whole working at home for 3 or 4 months is going to do to office needs in the future. More square footage for more distancing, less square footage to have more people work at home. I really don't know what the answer is right now, but that's when we're pausing on for the most part. But we have seen a couple opportunities that are so low leveraged that we're very comfortable moving forward. So we look at everything, and our stock and trade is we get back to them as quickly as possible if we're not interested, usually within a day, so that we don't waste anyone's time.
Kevin, since you're in the suburban office right now, how's your thoughts on the suburban office market, with the ideas that people may want to stay closer to the home, and also with the fact that a number of the suburban offices in New Jersey and in Westchester, which were closed, became residential apartments. Are you more bullish today on suburban office?
Well, it could be an opportunity for suburban office. I think we have 25% of our workforce back into the office, and the biggest pushback we got was in Brooklyn and New York with the mass transportation. So I think because people and people going up the elevators, the high rises and things like that. So I think the office buildings in suburbia, there is anecdotally, I've been speaking with a number of developers that have had office complexes in the city calling them about working in Garden City and in suburban New Jersey. So the brokers have never been busier out in this point of view in recent years. So I think it will, in the short term, I think like Dan said, in the short term, I think it'll be a reaction over the next 12 to 18 months that people will want to come out of the city, be in the more suburban complexes, not have to deal with the elevators going up in the high rise, not having to deal with the buses, the mass transportation, the trains, and the subways. But I think longer term, I would never, like Warren Buffett said, don't bet against America. I wouldn't bet against New York City. You look back to 2008, 2009, how the city came back, the multifamily came back. You look at post 9/11 downtown New York, it came back rather quickly, and it's just so dynamic a city. This metropolitan area, it's in a class by itself, and I would never bet against it.
Blair, where do you see the opportunities for the M&T in the C&I platform over the next couple of months?
I see a number of companies that may not fit well with sort of the bulge bracket banks, and who may need perhaps a little bit more complexity in products and services than some of the sort of much smaller banks. We play a really nice niche of providing very customized service to companies in sort of the old school banker kind of way, where you've got somebody who lives and works in your community, but you've still got that full complement of big bank services, whether it's debt capital markets execution, or we've got everything from corporate cards to Forex to all that sort of thing, asset-based revolvers. In times like these, there's always movement. People end up in tough situations with their banks sometimes, and sometimes they end up in really good positions where they need additional capital, and sometimes it's just not there. So with movement, that creates opportunity for institutions like M&T to step in and provide sort of tailored white glove service to a company that needs to grow, and that's where we can really step in.
Since I'm a baby boomer, and I consider Mr. Harris isn't too far away, and neither is Mr. Cummings. There's been, Frank, I'm not sure about yet, okay? But going over this, Blair, we know you're not. There's been a number of senior housing developments being built, some luxury ones. There are 4 luxury senior housing developments in New York City. New Jersey has had a significant number. Westchester has a number. Where do you see the senior housing market in the role of the banks, your banks specifically? Kevin?
I tell you, I would be hesitant to finance one in that densely populated area right now, especially those, over 60 are somewhat fearful and really worried. I was surprised, I'm kind of bullish. I've been kind of, I was a great supporter of our governors, and I just think the thing is dragging on too long. It's become too political, and I want people to get back to normal, get the restaurants open, get things moving forward, and be more positive in the messaging that is out there. I even went on the CDC website, and I think over 80% of the people, and the median age is like 80 years old, of people that have passed away to the virus. 80% of the people are over 65. So when you look at it, I think there is a hesitancy to put people that are at risk over 65 into densely populated area. And if I had my parents were still alive, they'd be in their late 80s, 90s, and I would say, stay home, stay put, stay in New Jersey where it's less populated and it's safer for you. So to finance a project in the more densely populated areas like New York City, like Hoboken, Jersey City, I'd be hesitant to back those projects now because of this current mindset of the constituents that would be interested in that product.
I mean, has anyone else done senior housing over here on this group?
Well, Mike, we've participated in a recent deal, right, substantial one here in our own backyard. Living on Long Island, particularly in Nassau County, for the past 30 years, I can see that it's a multi-generational environment, and meaning the parents don't want to leave. Homes are transferring over to the children, and there is no place for the parents to go. So I agree with Kevin. To be in a very large development could be somewhat risky at this point in time, but a suburban type setup, be a garden style 1 or 2 story development, I think there's a tremendous demand there. And it really helps serve families in the communities who have parents who don't need the full house, or maybe in their 80s and just need to be close to their children. So I still see that as a very good market. I think one of the challenges they have is when you have facilities like that, they need to be closer to longer term care. What we're starting to see here is people who tend to live longer will develop other needs, and some of it's memory care. So I think, having developments that can make that full transition from senior living to some sort of assisted living, and unfortunately even into long-term care for memory, I think there's a really good opportunity out there. I know there's one going on over here in Leviton. It's just about to be opened up. COVID environment has delayed it, but I understand that they're pretty full. I actually have a family member on a waiting list there, so I still think there's great opportunities there.
We're not going to have 6 to 7 million visitors to New York City. Certain people are thinking making apartments out of this. Certain people are thinking of a different highlighted co-working space. How are we going to reposition some of the retail and the hotels?
I'm not quite sure, Mike. I think when you talk about the retail, let's talk about Restaurant Row and the theater district. I think there's still a lot to be seen and learned about, how we're going to move forward. I mean, when you go to one of these restaurants, Sardi's or any one of those places, they used to just pack them in and jam as much as they could do in the 3 or 4 hour range. The theaters aren't coming back anytime soon. I'm not a particularly large guy, but I have a tough time fitting in those seats, myself. So now you're going to have even less people in the theater, less people coming to dinner. I don't know what you can do with those buildings other than, flip them back to a 2/1 or a 3/1. Every neighborhood's got a different spin on it. I was up in the Bronx yesterday. I spent most of the day traveling around. I was in the Morrisania section. I was over by Yankee Stadium. I drove up Jerome Avenue to 95. I came back down Westchester Avenue. That's a completely different area. The retail over there is substantially open. I did not notice that there was a lot of business activity that abandoned their stores. I think they're trying to figure out how to get back in. And talking a little bit about Yankee Stadium, I'm not sure what they do. Everybody knows what it's like to go to a Yankee game. It's crowded, and you can't get down Jerome Avenue. You can't get anywhere. I think we got a long way to go before we figure that out. But I know there's a pent up demand for people to do some things. So I think people are creative. We'll figure it out. But I think we got a ways to go with that.
Number of rental apartment buildings in New York City and in New Jersey, Kevin, and other places have been dependent on student housing. Where do you see the apartments that may have been taken out of the market because students may not be coming back? Certain institutions have stated that they're only going to have remote next year. What effect is this going to have on the multifamily business?
Well, it's certainly going to impact the student housing, and it's on a college by college basis. We haven't heard about Rutgers yet. We're waiting to hear about Penn State. I think, was it Clemson had a breakout with some of their football players that were down in preseason practicing on campus. So a lot of that is going to impact on the decisions that people make. But again, when you look at the risk of a student, it's pretty low. There was an article in the Wall Street Journal that talked about the chance of dying, someone under the age of 55 dying from the virus, is you're more likely to get into a car accident driving on your 16-mile commute every day to work. So I think it's that type of, the type of environment that we have today, like I asked the question, why can't the colleges open? What is the risk? I think, I went through again the CDC guidelines. I think the number of deaths across the country is under 13,000 for people under the age of 55. How many people die in car accidents over the course of a year? I think it's something like 50,000. We have to, get people to look at some of these statistics. And I think the hospitals and the doctors and everyone else have learned a lot from the battles of March and April and May. And we need to move forward with a sense of confidence to get things opened. I think Frank makes a good point. I think I read recently that the theaters aren't going to open up until January. What does that mean to all the businesses that are supported by the theater goers? And, a half a loaf is better than none. If they can get things open and get people working, get the unions to cooperate, and, everyone be reasonable around the table, we'll save a lot of those restaurants, because with the takeout, 25, 50%, head count, they can hopefully manage and at least pay their bills and keep the lights on.
Okay, with regard to retail today, are any of you looking at, standalone retail, retail that may have a Burlington, a TJ Maxx, a Target, which are really highly desirable today and doing well?
We've looked at a number of those. We've executed on some of those. It's case by case. It's, you do a lot of work on the major tenant or tenants, and that's worked out very well for us. Just to point back on the student loans, I just found out yesterday Michigan is going back, and what a lot of the schools are doing an abbreviated session where you show up in late August, September, and you don't leave till Thanksgiving. You don't come back till after Christmas to minimize people visiting and coming back. That being said, to the extent there is student housing in that area, it in many cases is preferable to dorm housing because you have your own place. There's 2 or 3 people sharing bathrooms and things like that. So student housing, to the extent the school reopens, could actually be an advantage. Back to your original question, we like the credit tenant space a lot. A lot of banks are on pause right now with new business, understandably. So to the extent you're still out there and active like we are getting looks at things that we might not otherwise have. And, we're certainly willing to do that type of a loan.
All of you have been, over the last couple of years, have been involved with a participation of loans with other banks. Do you see in this age of COVID more participation or more club deals, as they said, as opposed to people doing it themselves? Frank, Kevin? I know.
I think it's a little slow right now, Mike. We do have an appetite for, participating with other lenders. I know we've worked with Kevin in the past, and we've worked with M&T in the past. We're just not seeing the supply, but I think that's probably a product of everybody just minding the store right now. But we would certainly welcome the opportunity. I mean, credit's a good credit, and we do have some excess liquidity on our balance sheet that we'd like to put to work. Getting back to your credit tenant scenario, we recently did a chain of pharmacies, credit tenant, probably just closed it first week in March. So, I was a little bit concerned at first, but at the end of the day, it ended up being a very good transaction. It was a nice sized portfolio for a few people. But we actually have found that many local operators that are essential businesses that did not compete with the internet actually have performed fairly well through this COVID-19 environment. And really their ability to continue to pay rent has probably been better than some of the brand names that you may have read about that have had difficulties with timely payment of rents to landlords. So we would certainly look at essential businesses on a national chain basis, but we're still very comfortable with what's going on locally. Look at there are a lot of good little pizza shops around that survive, small strip centers that have stores, whether there's a 7-Eleven or something in there. There's just a little harder to find those at this point. But we do believe that the communities that we serve are going to be as vibrant as they were. We'll see how profitable they are. But as I said, visiting the Bronx yesterday, I was quite pleased to see the number of stores that are open and that people are out and about going about their way.
You know, earlier this year, before COVID came as the number one topic, the topic of interest was the co-working, the WeWork type of thing. How do you see your clients or your borrowers who have co-working facilities in the future, especially because of the compactness, you know, the telephone booths, the different approaches? How do you see that? And if you have it in your portfolio, how are you planning to handle it? Kevin?
I think, again, it's like a restaurant. You know, it's going to be 25, 50% initially. It's going to come back slowly. And it's one of the assets that are like restaurant and hospitality that's going to, you know, not perform well in the future, because basically people are not going to want to come back. The only good thing about that is you probably have a younger demographic that might be more willing to come back and fill up the available space more quickly. I think Blair hit something earlier. When you start talking about new lending, I think everyone's going to be a little bit careful about expanding the portfolio, staying focused on your customers, and working with this. We have like a war room type attitude, and we're going, especially with the implementation of CECL, you know, the new allowance for loan loss, the new accounting for allowance for loan loss. We're really diving into all the loans that we put out deferrals on and seeing, you know, rating change, second level of deferral, 3 months, 6 months, and really trying to develop a qualitative case so that we can review the model that Moody's puts out that's going to, you know, drive the provision for loan losses for the second quarter. It's a lot different process than it was under the old accounting. So when you look at things, you know, it's not business as normal. It's business unusual. And it should be war room like, being a creditor, being your loan review group, being in the risk management group. It is very important for us to get behind the numbers, look at people individually, and work with our customers so that we can have a reasonable workout plan. You know, one, you know, to reduce our losses at the bank, but two, to help, most importantly, to help our customers and to help the country get back on its feet. It is unprecedented where we are today, Mike. We're in this la-la land right now, and I'm telling people, you know, gear up, and it's going to be some rough seas ahead of us.
So I think in summation, everybody's lending under a very cautious optimism, okay? But they have to be careful because of the 3 to 6 month and we don't know what's going to happen. And, you know, as I always said on some of my other webinars and my shows, you know, I started a show right after 9/11. Okay, everybody said Lower Manhattan would never return. Lower Manhattan returned. 2008, 2009, everybody was worried there's a return. The question is how long it's going to be to return. And I think what Blair and Kevin and all of you have said is know your borrower, maintain a good relationship. We're interested in meeting some new borrowers, but they better meet the quality test, the testing over there. And I think you guys, we know that all the banks over here, Dan Harris of Ocean First, Kevin Cummings from Investors Bank, Frank Kozakwinski of Flushing, and Blair Ryder of M&T are in lending. And I'd like to thank you today. This is Mike Stoller for the Stoller Report and for Stephen Napolitano, Senior Executive Vice President of AmTrust Title. See you soon. Thank you.